If you have $100,000 and your first instinct is to make it grow fast, you're already thinking in the wrong direction. That's not an insult. That's the trap. Most people who start with $100,000 never turn it into $1 million. Not because they're unlucky, not because they're lazy, but because they rush, overthink, or chase the wrong kind of growth. And Warren Buffett saw this pattern again and again. People think the hard part is getting to $100,000. It is hard. It takes discipline, patience, and time. But here's the uncomfortable truth most people don't expect. Getting from $100,000 to $1 million is less about effort and more about behavior. Buffett didn't believe wealth is built by constantly doing something. He believed it's built by not doing the wrong things for a very long time. That's already surprising to most people. Because if you ask the average person how to turn $100,000 into $1 million, they'll give you answers like, invest more aggressively, take bigger risks, find the next big thing, move faster. Buffett would quietly shake his head at most of that, not because growth is bad, but because fragile growth breaks. And $100,000 is a dangerous amount of money for one simple reason. It's enough to feel confident, but not enough to survive big mistakes. That's where most people mess up. They feel rich enough to gamble, but not rich enough to recover. Buffett understood that this stage is where discipline matters more than intelligence. Because with $100,000, you finally have options, and options tempt people into bad decisions. You start thinking, I can afford to take a little risk. I can speed this up. I don't want to wait decades. That thinking destroys more portfolios than bad math ever does. Buffett didn't get rich by trying to turn money into more money quickly. He got rich by letting time do the heavy lifting while he stayed out of trouble. And that's the part nobody likes to hear. Because time feels slow, because patience feels boring. Because boring doesn't sell dreams, but boring compounds. Here's something most people don't realize until it's too late. The difference between $100,000 and $1 million isn't hustle. It's not screwing up. You don't need genius, you don't need perfect timing, you don't need secret strategies. You need a system that lets money grow without you getting in the way. Buffett believed the biggest enemy of compounding is not inflation or taxes. It's human behavior. People panic, they get greedy, they chase stories, they react to noise, and every reaction interrupts compounding. Most people treat $100,000 like a ticket to speed. Buffett treated it like something fragile that needed protection. That mindset alone changes everything. Because once you see $100,000 not as capital to flip, but as a seed that must survive, your decisions slow down. And slowing down is exactly what compounding needs. Here's the uncomfortable part. Most people don't fail to reach $1 million because returns were too low. They fail because at some point they did something unnecessary. They chased an idea they didn't fully understand. They tried to outsmart the market. They reacted to fear or excitement. Buffett always said the market doesn't punish ignorance. It punishes impatience. And $100,000 tests patience like nothing else. It's enough to make you feel close. Close enough to rush. Close enough to compare yourself to others. You start watching what other people are doing. You hear stories of fast wins. You feel pressure to do something. Buffett felt that pressure too. He just ignored it. He understood that the real question isn't how fast can this grow, but how likely is this to survive for 20 or 30 years? That question changes everything. Most people want the fastest path to $1 million. Buffett wanted the most certain path, even if it was slow, because slow and certain beats fast and fragile every time. Another mistake people make at $100,000 is thinking this is the moment to be clever. Buffett didn't admire clever. He admired durable. He knew that clever strategies break under stress. Durable strategies don't. And stress always shows up. Markets fall. Economies slow. Headlines scream. If your plan requires constant confidence, it will fail the moment confidence disappears. Buffett built plans that worked even when he felt unsure. That's the difference. Most people think wealth comes from being right. Buffett believed wealth comes from not being wrong in a big way. That's especially true at $100,000. At this level, one bad decision doesn't hurt your ego, it hurts your future. And Buffett never forgot that. He didn't treat $100,000 as money to multiply. He treated it as capital that must endure. Because endurance is what creates compounding. Here's another thing that surprises people. Buffett didn't focus on how much money he could make in a year. He focused on how long his money could stay invested without being touched. That's a completely different mindset. Most people plan in years. Buffett planned in decades, and that's why his results look unreal. The truth is, turning $100,000 into $1 million is not about finding the perfect investment. It's about building a mindset that protects compounding. That mindset includes being comfortable doing nothing, ignoring short-term noise, saying no far more than yes, accepting that progress will feel slow, avoiding anything that could wipe you out. Buffett understood that once money is gone, time can't bring it back. That's why he avoided anything that depended on being right quickly. He didn't want speed. He wanted staying power. Because staying power is what lets compounding work. Another hard truth, most people don't really want to turn $100,000 into $1 million. They want to feel smart, they want excitement, they want a story. Buffett didn't care about stories. He cared about outcomes. And outcomes come from boring consistency, not dramatic moves. That's why this topic matters so much. Because almost everyone asks the wrong question. They ask, what should I invest in? Buffett asked, what could destroy me? Avoiding destruction came first. Growth came second. And if you reverse that order, the odds flip against you. This video isn't about giving you a trick or a shortcut. It's about showing you how Buffett thought at the exact stage where most people mess everything up. Because $100,000 is where discipline either locks in or falls apart. It's the point where you stop being poor, but aren't rich enough to recover from arrogance. Buffett respected that stage. He treated it with caution, with patience, with humility. And that's why his approach feels boring and works. By the end of this video, you won't see $100,000 the same way again. You'll stop asking how fast it can grow. You'll start asking how safely it can compound. And that shift is the difference between people who eventually reach $1 million and people who stay stuck forever wondering why it didn't work. Before we go any further, we need to clear up one big misunderstanding. This video is not about tricks, it's not about shortcuts, and it's definitely not about turning $100,000 into $1 million quickly. Warren Buffett never believed wealth was built that way. In fact, if you're watching this hoping for a clever move, a secret stock, or a fast timeline, Buffett's approach will probably disappoint you at first. And that's exactly why it works. Buffett didn't build wealth by doing more. He built it by doing less, but doing it consistently and for a very long time. That idea alone goes against how most people think about money. Most people believe that once they reach $100,000, they need to shift gears. Become more aggressive. Take bigger swings. Speed things up. Buffett believed the opposite. He believed that $100,000 is the moment where mistakes become expensive, and discipline matters more than ever. This intro is about understanding that mindset, because if you don't understand how Buffett thought, his results will feel impossible to copy. Not because you lack money or intelligence, but because your expectations are misaligned. Buffett didn't ask, how can I make this 10 times bigger as fast as possible? He asked, how do I avoid losing this for the next 30 years? That question changes everything. Most people underestimate how fragile $100,000 really is. Yes, it's a lot of money, but it's not enough to survive big errors. It's not enough to recover easily from panic or greed. Buffett knew that the fastest way to never reach $1 million is to act like you already have it. This is why his approach feels conservative at first. He treated $100,000 like something precious, not because it was small, but because it was the foundation. You don't build tall buildings by rushing the foundation. You don't speed up compounding by shaking it. Buffett always started with the foundation. Another misunderstanding is that Buffett was always confident and calm. He wasn't immune to fear or doubt. He just designed his decisions so fear didn't force action. That's a key difference. Most people feel fear and then react. Buffett felt fear and then waited. Waiting is uncomfortable for most people. It feels like inaction, like missed opportunity. Buffett saw waiting as part of the strategy. Because time doesn't reward constant movement, it rewards consistency. This intro matters because if you don't reset your expectations, the rest of this video will feel underwhelming. And then you'll miss the point. Turning $100,000 into $1 million is not about making money work harder. It's about keeping it working uninterrupted. Interruptions kill compounding. Selling too early, switching strategies, chasing performance, panicking during downturns. Buffett avoided all of that. He didn't try to predict markets. He didn't try to time cycles. He didn't try to impress anyone. He focused on one thing, staying invested in things he understood, for as long as possible, without being forced to sell. That's the core of it. Most people think Buffett's success came from genius stock picking. In reality, it came from not interfering with compounding. And $100,000 is exactly the amount where interference usually starts. You finally feel like an investor. You finally feel capable. You finally feel close. And that feeling pushes people to overdo it. Buffett did the opposite. He became more selective, not more active. Another important point. Buffett didn't separate investing from behavior. Most people talk about strategy as if emotions don't exist. Buffett assumed emotions would always exist and planned around them. He knew people get greedy when things go well. He knew people panic when things go bad. So he designed a strategy that didn't require perfect emotional control. That's why his approach is simple. Simple beats complex when emotions enter the picture. Complex strategies break when stress hits. Simple ones survive. Buffett believed survival was the first requirement of wealth. If you don't survive downturns, you don't get to compound. If you don't compound, you don't reach $1 million. Everything starts there. Another reason this intro matters is because people often misunderstand time. They hear long-term and think it means vague patience. Buffett meant something very specific. He meant letting years pass without changing course. That's hard. Most people say they're long-term investors, but act short-term. They check prices constantly. They react to headlines. They compare themselves to others. Buffett ignored most of that. He understood that comparison is poison to compounding. If you're constantly measuring your progress against others, you'll always feel behind. And feeling behind leads to rushing. Rushing breaks compounding. That's why Buffett stayed in his own lane. This video is not about copying Buffett's exact investments. It's about copying his thinking at the $100,000 stage. Because that stage is where people usually self-sabotage. They think they need to be smarter. They think they need to be faster. They think they need to be more aggressive. Buffett believed they needed to be more patient. He believed the difference between people who eventually reach $1 million and those who don't often comes down to one thing. Can they sit still when sitting still feels uncomfortable? Most people can't. They confuse activity with progress. They confuse complexity with intelligence. They confuse movement with growth. Buffett didn't. He understood that doing nothing is often the hardest and most profitable decision. That doesn't mean ignoring opportunities. It means being selective. He said no far more often than he said yes. And when he did say yes, he stayed. That's how compounding actually works. Another key idea Buffett lived by is that money doesn't need to be exciting to be effective. Most people want investing to feel rewarding in the short term. Buffett wanted it to work in the long term. Those goals often conflict. Short-term excitement usually comes with long-term risk. Long-term results usually feel boring in the short term. Buffett chose boring. That choice doesn't get talked about enough. Because boring doesn't sell. Boring doesn't trend. Boring doesn't go viral. But boring builds wealth. This intro sets the tone for everything that follows. We're not going to talk about timing markets. We're not going to talk about flipping assets. We're not going to talk about beating everyone else. We're going to talk about not losing, not rushing, and not interrupting compounding. That's Buffett's real edge. And once you understand that, the idea of turning $100,000 into $1 million stops feeling mysterious. It starts feeling inevitable, if you can stay patient long enough. The problem is, patience is simple to understand and extremely hard to practice. That's why so few people actually do this successfully. They know the math, they know the theory, but behavior gets in the way. Buffett designed his entire approach to protect himself from his own behavior. That's what made him dangerous. And that's what we're about to break down next. Because once you understand why most people fail at this stage, Buffett's approach starts making sense in a very practical way. Very practical. The biggest problem at the $100,000 stage isn't lack of opportunity. It's not lack of access. It's not lack of information. It's not even lack of intelligence. The real problem is behavior under pressure. Once people reach $100,000, something changes psychologically. They stop thinking like savers and start thinking like investors. And while that sounds positive, it's exactly where most mistakes begin. Before $100,000, the goal is clear. Don't mess up, keep saving, stay disciplined. But after $100,000, the goal becomes fuzzy. People start asking new questions. How do I grow this faster? What am I missing? Why am I not further ahead? Those questions create pressure, and pressure changes behavior. Buffett understood that this stage is dangerous not because of markets, but because of emotions. The first major problem is the urge to speed things up. At $100,000, time suddenly feels expensive. You can see the gap between where you are and where you want to be. You start calculating years, decades. You start imagining how long it will take. That creates impatience. People don't want to wait 20 or 30 years. They want a shortcut, something to accelerate progress. Buffett knew this urge was the enemy, because compounding doesn't respond well to impatience. It needs consistency, not urgency. Most people sabotage themselves by trying to compress time. They take risks they don't fully understand. They move money around too often. They chase performance. And every one of those actions interrupts compounding. The second problem is overconfidence. Reaching $100,000 feels like proof that you're good with money. You did something right. You stayed disciplined. You made smart choices. That confidence feels earned, and sometimes it is. But Buffett knew confidence can quietly turn into arrogance. People start believing they can outsmart the market, that they see patterns others don't, that their success came from skill rather than consistency. This belief leads to complexity. They add more strategies. They experiment more. They try to optimize. Buffett avoided optimization at this stage. He believed optimization increases fragility. Simple systems survive stress, complex ones break. The third problem is noise. Once people have real money invested, they start paying attention to everything. News, headlines, social media, other investors' opinions. They compare constantly. Comparison is toxic at the $100,000 stage. You see others claiming huge gains. You see stories of fast success. You feel like you're falling behind, and feeling behind pushes people to act. Buffett ignored noise on purpose. He knew that reacting to noise creates activity, not progress. The fourth problem is mistaking volatility for danger. At $100,000, market drops feel personal. A 20% decline suddenly means real money. Money that took years to build. People panic. They sell to protect themselves. They wait to get back in. They miss recovery. Buffett understood that volatility is the price of compounding. If you can't tolerate volatility, you can't compound. The problem is that most people don't realize this until they experience it, and by then, emotions are already involved. The fifth problem is strategy hopping. People move from one idea to another, not because the ideas are bad, but because results aren't immediate. They abandon good strategies for exciting ones. They confuse patience with stagnation. They assume slow progress means failure. Buffett stayed put. He knew that compounding looks broken in the early years. It feels like nothing is happening. That's normal. Most people don't give compounding enough time to prove itself. The sixth problem is underestimating the damage of mistakes. At $100,000, mistakes hurt more than people expect. A bad decision doesn't just reduce money, it steals time. Years of compounding disappear. Buffett always thought in terms of time lost, not just dollars lost. That's why he focused so much on avoiding big errors. Most people think wealth comes from winning big. Buffett believed wealth comes from not losing big. The seventh problem is false diversification. People spread money across too many things they don't understand. They think diversification means safety, but it often just means confusion. They don't know why they own what they own. They don't know what would make them sell. They don't know what risks actually matter. Buffett believed ignorance multiplied risk. He preferred fewer, well-understood positions. The eighth problem is Inflation of lifestyle expectations. As portfolios grow, so do expectations. People start imagining future spending, bigger homes, early retirement, lifestyle upgrades. Those expectations create pressure. Now the portfolio isn't just money, it's a promise to a future lifestyle. That makes people emotional. Buffett avoided lifestyle pressure early. He lived simply so money could grow quietly. The ninth problem is misunderstanding timeframes. People expect visible progress every year. But compounding doesn't work like that. Some years look flat, some look disappointing, some look scary. Buffett accepted uneven progress. He understood that compounding is lumpy. Smooth expectations cause disappointment. Disappointment leads to bad decisions. The 10th problem is thinking action equals intelligence. Many people believe smart investors are active investors. Buffett believed the opposite. He thought inactivity was often a sign of confidence. Knowing when not to act is a skill. Most people don't have it. The 11th problem is fear of missing out. At $100,000, people start hearing about opportunities everywhere. New assets, new trends, new strategies. FOMO pulls people away from their plan. Buffett stayed focused. He knew missing out is less dangerous than messing up. The 12th problem is emotional attachment. People get attached to ideas, predictions, and narratives. They want to be right. Buffett didn't care about being right. He cared about outcomes. Attachment clouds judgment. The 13th problem is lack of margin of safety. Many people invest all their money aggressively. They leave no buffer. When life happens, they're forced to sell. Buffett always kept margin. He wanted flexibility. The 14th problem is short-term validation. People want proof they're doing well. Likes, praise, confirmation. Buffett didn't seek validation. He trusted his process. The 15th problem is forgetting the real goal. The goal isn't excitement. It's not bragging rights. It's not speed. The goal is letting time work uninterrupted. Most people forget that once money becomes meaningful. Buffett never did. He saw $100,000 as the most dangerous stage, not because it's small, but because it tempts people to interfere. Interference kills compounding. That's the problem in one sentence. And until that problem is understood, no strategy will work. Because the enemy isn't the market, it's the urge to act. Now that we've clearly identified the problem, the next step is understanding how Buffett structured his approach to avoid these traps, and what actually works at this stage. Once Buffett understood the dangers of the $100,000 stage, he didn't respond by becoming more aggressive. He became more intentional. That's the first thing most people get wrong. They think the next step is action. Buffett believed the next step is restraint. He knew that at this stage, the goal isn't to maximize returns. The goal is to protect the process. Because if the process survives long enough, the outcome takes care of itself. Buffett didn't wake up every day asking how to grow his money faster. He asked how to avoid doing something stupid. That sounds simple, but it's incredibly hard. Most people feel uncomfortable when nothing is happening. Buffett got comfortable with that feeling early. The first thing Buffett focused on was clarity. He only invested in things he could explain simply. Not because he wasn't capable of complexity, but because complexity hides risk. If he couldn't understand how a business made money, how it could lose money, and why it would still exist years from now, he walked away. This rule alone eliminates most bad decisions. At $100,000, people feel pressure to find opportunities. Buffett felt pressure to avoid traps. He understood that missing a good opportunity doesn't nearly as much as committing to a bad one. So he waited. Waiting is uncomfortable because it feels unproductive. Buffett didn't care about feeling productive. He cared about being right over time. The second thing Buffett focused on was time horizon. He wasn't interested in what an investment might do this year or next year. He thought in decades. That long horizon changes how you see everything. Short-term drops stop feeling dangerous. Volatility becomes background noise. Patience becomes an advantage instead of a weakness. Most people say they're long-term investors, but they still react to short-term movements. Buffett aligned his behavior with his words. He acted as if he wouldn't need the money for a very long time. That assumption gave him calm. The third thing Buffett focused on was simplicity of strategy. He didn't jump between approaches. He didn't reinvent his plan every year. He didn't chase trends. He picked a small number of principles and followed them relentlessly. Consistency compounds just as much as money does. Most people underestimate how powerful consistency is because it looks boring from the outside. Buffett knew boredom was a feature, not a flaw. The fourth thing Buffett did was separate ego from investing. He didn't need to be right publicly. He didn't need to impress anyone. He didn't need stories. This matters more than people realize. At $100,000, ego becomes dangerous. People want to prove they're smart. They want to beat the market. They want to talk about wins. Buffett didn't care. He cared about results decades later, not applause today. That mindset keeps you out of trouble. The fifth thing Buffett focused on was quality over activity. He didn't believe frequent decisions lead to better outcomes. He believed fewer, better decisions lead to better outcomes. He said no far more often than yes. Most people think opportunity is scarce. Buffett believed patience creates opportunity. When you're not desperate, you can wait for good setups. The sixth thing Buffett understood deeply was margin of safety. He never invested assuming everything would go right. He assumed some things would go wrong, so he demanded room for error. This means buying with a cushion, avoiding leverage, keeping cash available. Margin of safety isn't exciting, but it's powerful. It allows you to survive mistakes without panic. At $100,000, panic is the real killer. The seventh thing Buffett focused on was not touching the money. This sounds obvious, but it's critical. Every time you move money around, you reset compounding. You create friction. You invite emotion. Buffett avoided unnecessary movement. He believed inactivity was often the best decision. That belief runs against modern investing culture, which rewards constant engagement. Buffett ignored the culture. The eighth thing Buffett did was align incentives. He paid attention to who benefits when something grows. Businesses with strong incentives, honest management, and clear value creation were favored. This alignment reduces surprises. Surprises destroy compounding. The ninth thing Buffett focused on was behavior during downturns. He didn't prepare by predicting crashes. He prepared by building a mindset that could handle them. He expected downturns. He didn't fear them. Fear causes selling. Selling breaks compounding. Buffett stayed invested when others panicked, not because he was fearless, but because he planned for fear in advance. The 10th thing Buffett did was avoid leverage. Leverage magnifies mistakes. At $100,000, mistakes don't need magnifying. Buffett understood that debt forces action at the worst times. He avoided anything that could force him to sell. Freedom to wait is everything. The 11th thing Buffett believed is that time is the real multiplier, not intelligence, not speed, not complexity. Time rewards consistency and punishes impatience. Most people try to outsmart time. Buffett partnered with it. The 12th thing Buffett focused on was process over outcome. He didn't judge decisions by short-term results. He judged them by whether they made sense at the time. This mindset protects confidence during bad periods. Bad periods are guaranteed. The 13th thing Buffett understood is that wealth grows quietly. There are long stretches where nothing seems to happen. People quit during those stretches. Buffett didn't. He understood that compounding is invisible before it becomes obvious. The 14th thing Buffett focused on was self-awareness. He knew his own weaknesses. He knew where he could make mistakes, so he avoided situations that tested those weaknesses. That's wisdom. The 15th thing Buffett did was keep expectations realistic. He didn't expect miracles. He didn't promise himself fast outcomes. Realistic expectations prevent disappointment. Disappointment leads to bad decisions. Buffett never rushed himself. The 16th thing Buffett understood is that most people don't fail because they choose the wrong investment. They fail because they abandon the right one too early. Staying is harder than starting. Buffett mastered staying. The 17th thing Buffett focused on was protecting mental calm. Stress leads to reaction. Reaction leads to mistakes. He structured his life and investments to reduce stress. That calm is part of his edge. The 18th thing Buffett believed is that money should work harder than emotions. When emotions lead, money suffers. So he built systems that removed emotion from decisions. The 19th thing Buffett focused on was long-term alignment. He didn't invest in things that depended on constant change. Stability compounds better. The 20th and most important thing Buffett understood is this: turning $100,000 into $1 million is not about doing something special once. It's about doing nothing stupid consistently. That's the development in one sentence. Everything Buffett did was designed to support that goal. Now we're ready for the turning point, the moment where this thinking becomes undeniable and personal. This is the moment where people usually pause the video, not because they're bored, but because something feels too close. Because by now, the pattern should be clear. Most people don't fail to turn $100,000 into $1 million because they chose the wrong stock. They fail because at some point, they lost patience. And patience doesn't disappear loudly. It disappears quietly. It disappears when progress feels slow, when comparison creeps in, when someone else seems to be winning faster. That's when people break their own plan. Buffett understood this moment better than anyone. He saw it happen to smart people, disciplined people. People who had already done the hard part by saving and reaching six figures. They didn't blow up overnight. They didn't gamble everything. They didn't act reckless. They made small, reasonable decisions that felt smart in the moment. And those decisions added up to failure. This is the uncomfortable truth. Most financial damage happens after you feel confident, not before. Before $100,000, people are careful. They don't want to mess up. They protect what little they have. After $100,000, caution fades. People start thinking they've earned the right to take risks. They believe they're ready for something more advanced. Buffett knew this belief was dangerous, because compounding doesn't care how ready you feel. It only cares how long you stay invested without interruption, and interruption is exactly what confidence invites. This is where the illusion fully breaks. People realize that the biggest threat to turning $100,000 into $1 million is not bad markets, inflation, or even bad investments. It's interference. Interference from fear, greed, boredom, comparison. Buffett didn't eliminate these emotions. He designed around them. That's the part most people miss. They think discipline means controlling emotions. Buffett believed discipline means not putting yourself in situations where emotions get tested constantly. That's wisdom. The climax is understanding that wealth isn't built by intensity, it's built by endurance. Endurance is boring. Endurance doesn't look impressive. Endurance doesn't give quick feedback. But endurance is what allows compounding to reach its later stages. Most people never see those stages. They quit too early. They change direction too often. They lose faith when results lag expectations. Buffett didn't. He trusted time more than he trusted his feelings. This is where people start recognizing their own past behavior. Moments where they sold too early. Moments where they switched strategies. Moments where they chased something new because the old plan felt slow. Those moments felt justified at the time. Buffett knew justification is how most people sabotage themselves. You don't need a bad reason to make a bad decision. You just need a reason that feels good enough. That's what impatience provides. Another realization hits here. Most people don't really want $1 million. They want relief. Relief from waiting. Relief from uncertainty. Relief from feeling behind. And that desire for relief pushes people into decisions that trade long-term outcomes for short-term comfort. Buffett didn't seek relief. He accepted discomfort. Waiting is uncomfortable. Watching others move faster is uncomfortable. Doing nothing while others act is uncomfortable. But discomfort is temporary. Broken compounding is permanent. Buffett always chose temporary discomfort. The climax is also realizing how fragile confidence really is. People think confidence grows with success, but at $100,000, confidence often becomes a liability. You feel smart, you feel capable, you feel close, and feeling close makes people rush. Buffett treated closeness as a warning sign. He knew that the closer people feel to a goal, the more likely they are to make emotional decisions. That's why so many people blow up near the finish line. They speed up when they should slow down. The climax moment is when viewers realize that turning $100,000 into $1 million isn't a technical challenge. It's a psychological endurance test. Can you stick with a plan when it feels boring? Can you ignore noise when others are excited? Can you stay invested when nothing seems to be happening? Most people can't, not because they're weak, but because the world constantly pushes them to act. Buffett resisted that push. He didn't check prices constantly. He didn't react to headlines. He didn't explain himself to others. He stayed quiet. Quiet is powerful. Quiet gives compounding room to breathe. Another uncomfortable realization: most people don't actually believe compounding will work for them. They believe it works in theory, but not in practice. So they hedge emotionally. They keep looking for backups. They keep testing new ideas just in case. That hedging breaks focus. Buffett believed compounding works only if you stop questioning it constantly. You don't pull up a tree every week to see if it's growing. You let it grow. This is where people finally see why Buffett's approach feels boring but unstoppable. He removed drama from money. No excitement, no urgency, no constant decisions. Just time, consistency, and restraint. The climax is also realizing how rare this behavior actually is. Most people can't sit still. Most people can't ignore comparison. Most people can't wait without reassurance. That's why so few people reach $1 million starting from $100,000, even though the math is simple. The math isn't the problem. Behavior is. And behavior doesn't change because of information. It changes because of structure. Buffett structured his life to protect long-term thinking. He avoided environments that rewarded constant action. He avoided people who pushed him to move faster. He avoided systems that depended on timing. He built a calm bubble around his decisions. That calm bubble is the real secret. Not intelligence, not access, not luck. Calm. At this point, the viewer should feel something shift. Not motivation, not excitement, but clarity. Clarity that the reason most people never reach $1 million from $100,000 has very little to do with markets and everything to do with themselves. They weren't robbed. They weren't unlucky. They weren't missing information. They just didn't stay long enough. Buffett stayed. He stayed when progress was invisible. He stayed when others mocked patience. He stayed when nothing exciting happened. And because he stayed, compounding eventually became impossible to ignore. This is the climax because it reframes the entire goal. The goal isn't to find the best investment. The goal is to become the kind of person who doesn't interrupt compounding. That's rare, that's hard, and that's why it works. Once you see this, the pressure lifts. You stop chasing. You stop comparing. You stop rushing. You realize the race isn't against others, it's against your own impatience. And Buffett beat that race by refusing to run it. That's the moment everything clicks. When you step back and look at everything we've covered, one truth becomes very clear. Turning $100,000 into $1 million isn't hard because the math is complicated. It's hard because people get in their own way. That's what Buffett understood better than almost anyone. He didn't believe most people failed because they were unlucky, underpaid, or uninformed. He believed they failed because they couldn't stay calm long enough for compounding to do its job. And calm is rare. The world constantly tells you to move faster, to optimize, to chase what's new, to do something now. Buffett ignored that noise. He didn't ignore it because he was stubborn. He ignored it because he knew where it led. It led to interference, and interference breaks compounding. That's the central lesson. Most people don't lose money in one big mistake. They lose it slowly by making many small, unnecessary decisions. Decisions that feel reasonable at the time. Decisions driven by boredom, fear, or comparison. Buffett built a system that reduced the number of decisions he had to make. Fewer decisions mean fewer chances to mess things up. That's not weakness, that's wisdom. He didn't try to be active, he tried to be consistent. He didn't try to be impressive, he tried to be durable. And durability is what allows money to grow quietly for decades. Another important takeaway is this. Buffett didn't rely on motivation. Motivation fades. Excitement fades, confidence fades. He relied on structure. He structured his investments, his expectations, and his behavior in a way that made patience easier. That's why copying Buffett isn't about copying his picks. It's about copying his restraint. Restraint to not chase. Restraint to not panic. Restraint to not overthink. Most people think restraint feels limiting. Buffett knew it was freeing. Because when you remove pressure, you remove the urge to act. And when you remove the urge to act, compounding can finally work without interruption. Another thing that becomes clear is that Buffett never tried to feel successful along the way. He didn't need constant feedback. He didn't need reassurance. He didn't need short-term wins. He trusted the process even when it felt boring. That's incredibly hard to do in a world built around instant results. But boring is exactly what compounding looks like before it becomes obvious. Most people quit during the boring phase. They assume something is wrong, they assume they're behind, they assume they need to adjust. Buffett assumed nothing was wrong. He understood that silence is not failure. Flat years are not failure. Slow progress is not failure. Interruption is failure. That's why this approach works when so many others don't. It doesn't require brilliance. It doesn't require speed. It doesn't require prediction. It requires patience and self-control. And those two traits are far rarer than intelligence. Another uncomfortable truth is this. Many people don't actually want the process that leads to $1 million. They want the result, but not the waiting. They want the outcome, but not the boredom. They want the finish line, but not the discipline. Buffett accepted the entire package. He accepted that wealth takes time. He accepted that progress would feel slow. He accepted that others would look smarter in the short term. And he stayed anyway. That's why he won. This isn't about becoming emotionless or robotic. Buffett felt doubt. He felt fear. He felt uncertainty. The difference is that he didn't let those feelings drive his decisions. He didn't ask, "How do I feel about this today?" He asked, "Does this still make sense long term?" And most of the time, the answer didn't change. That's a powerful filter. Once you apply it, many tempting ideas lose their shine. Fast money looks fragile. Exciting strategies look risky. Constant action looks unnecessary. And slow, steady compounding starts to feel attractive. That shift in perspective is the real reward of understanding Buffett's approach. You stop chasing what feels good now and start respecting what works later. Another important realization is that Buffett never expected perfection. He didn't need every decision to be right. He just needed to avoid big mistakes. Avoiding big mistakes is much easier than making brilliant moves. It requires humility. It requires admitting you don't know everything. It requires saying no more than yes. It requires staying inside your limits. Buffett embraced limits. He knew that knowing what not to do is just as important as knowing what to do. Most people think success comes from adding more. Buffett believed success often comes from subtracting. Subtracting noise, subtracting emotion, subtracting unnecessary decisions. That's how you protect compounding. When you look at it this way, turning $100,000 into $1 million stops feeling mysterious. It becomes mechanical, not easy, but clear. Save first, invest carefully, avoid leverage, stay patient. Don't interrupt the process. Repeat that long enough, and the math eventually does the heavy lifting. The hard part isn't knowing this. The hard part is living it. That's why so few people succeed with it. Not because it doesn't work, but because it demands emotional maturity over a long period of time. Buffett had that maturity early. He wasn't in a hurry to prove anything. He wasn't competing with anyone. He wasn't measuring himself against short-term outcomes. He was playing a very long game. And in a long game, calm beats clever every time. If there's one final idea to carry with you from this entire video, it's this. Wealth grows best in environments where you don't feel forced to act. Buffett built his entire approach around that principle. No deadlines, no pressure, no need to rush, just time and discipline. That's why his method looks boring on the surface, but unstoppable over decades. It respects reality, it respects human behavior, it respects uncertainty, and because it respects those things, it survives. Most strategies don't fail because they're wrong. They fail because people abandon them. Buffett didn't. He stayed when it was quiet. He stayed when it was uncomfortable. He stayed when nothing exciting happened. And eventually, staying became the advantage. That's the real lesson behind turning $100,000 into $1 million. Not finding the perfect move, but becoming the kind of person who doesn't interrupt compounding. Once you understand that, everything else becomes simpler. Watch the next video.